We'll talk about key investment drivers, evolving risk-return profiles, new and emerging markets, and innovative investment strategies. So let's get started by letting our panelists introduce themselves and start at the very end with Maz.
Good morning, everyone. Miles Loo Jr, VP Investments at Goldacre. Goldacre is a London-based investment manager focused on data center investments. In the UK, we founded and built a data center platform called Kyriacos. We are building a data center platform called NED in Israel, and working on a few other development projects in the UK and Europe.
Go ahead, Kyriacos.
Hello, good morning, everyone. My name is Kyriacos Sabatakakis. Welcome to Greece. I'm the country managing director of Accenture in Greece, and I'm also in charge of Accenture business in the communications, media, and high-tech segments in Central and Eastern Europe. Obviously, as a company, we work a lot with infrastructure, cloud, and AI. But we're particularly proud that here in Athens, almost 20 years ago, we created one of the global centers of Accenture in data and analytics at the time. Now it's data and AI. And it's the only global such center of Accenture in Europe. So that gives us a great visibility of what's happening around the world in the world of AI. And thank you for inviting me here.
Thank you.
Good morning to everyone. I'm Achilles Risvas. I'm the CEO and Chief Investment Officer of Dromeus Capital. We are a thematic alternative investment manager. We invest globally across the asset classes. Our highest conviction investment idea today is in data centers, and it's centered on the structural mismatch between the exploding demand for data and actually the lack of infrastructure which is needed to support it. We currently own and control a number of sites across Europe, in various markets, Tier 2 primarily and Tier 3 markets, with over 800 MVA of grid-connected capacity.
My name is Chester Reid. I'm the Chief Financial Officer of Yondr Group. We're a global built-to-suit, single-tenant, hyperscale developer and operator. We have data centers in Northern Virginia, in Canada, in the UK, in Germany, in APAC. We have a JV in Japan. We have a JV in India as well. So we're a global platform. We supply for hyperscalers. We're hyper-focused on hyperscalers, big deployments, and obviously the AI boom and everything that's happened over the last number of years has been an incredible tailwind to our business, our peers and contemporaries' businesses as well.
Hello. Hello. I'm Avner Papouchado, CEO of Serverfarm, data center platform that's in the US, Canada, Europe, and Middle East. Been around this business almost as long as Miles has, like from the late 90s. So we've seen a lot of waves. This is a big one. So.
Good. Okay, I'm Miles Loo with Newmark. I've been in commercial real estate for 30 years. I started the very first data center valuation practice. We're invested in Germany, or excuse me, in Greece. I have Mina here, who's my colleague, who lives here in Athens. We've been in the last 12 months involved in over 1,000 valuations across 6 continents. That's over $100 billion, US dollars. Okay, so let's get started. So let's talk about investment drivers. Let's begin by examining the forces that drive investment in the data center market. Demand is clearly surging, but what specific trends are emerging? So we're going to start with Maz. Maz, Goldacre has a strong focus on tech-driven real estate. The scale of investment in digital infrastructure is changing rapidly. Can you elaborate how funding models are evolving to meet increasing investment requirements?
Yeah, I think given the rise of AI and investment requirements, what we are seeing is that funding models that are being adopted are slightly more holistic in nature. So in addition to more traditional approaches, like top equity financing or LTV and cash flow based lending, we are seeing different structures emerging. There are slightly more sophisticated equity structures being used. I would say as data center businesses continue to grow and parts of the business becomes to mature, different equity financing structures become available to them. So like yield costs, stable costs, dev costs, that allows data center operators to release capital from some of the stabilized assets and recycle back into growing the business, or just raise some external equity capital dedicated for certain growth projects, so raising at an asset level. I would say that we are also seeing some investors moving up the risk spectrum in some real estate investors, infrastructure investors. There's a lot of focus on hyperscale-backed investments that are very long-term cash flows, very secure. I think AI infrastructure investments can be slightly different, more dynamic. And I think those different equity financing structures allows investors to essentially pick and choose where they want to play in the capital structure and pick investments based on their preferred risk-return profile. Okay. And I would probably also add that we are seeing more partnerships in general. So obviously lots of partnerships between operators and financial partners, but also partnerships between PE houses, sovereign funds, and some industry strategics that I think really help to mitigate some of the risks associated with these large-scale investments.
Good. Okay, thank you. Avner, Serverfarm sees AI driving growth across data centers, fiber networks, and edge computing, which is a transformative shift towards more distributed infrastructure, right? So given Serverfarm's focus on digital infrastructure, how is the evolving landscape of AI, including recent market disruptions like DeepSeek, impact your investment strategies and risk assessment?
The big difference, that the big change right now, and really it's kind of a mystery, is how AI is going to change the traditional service areas of the hyperscalers, right? There used to be a model that's based on availability zones, which were very limited in scope. And AI came and at the beginning broke it, said, we can be anywhere, just give us anywhere, we'll go anywhere. And this is kind of the way things are going now. Anywhere there's power, they're going. Almost anywhere. So now they're starting to say a little bit, no, we're not going to Antarctica. That's a little far. We're, in Middle East is great, but how do we get there in fiber? What are the laws? What are can you actually scrape the net from there? Can you not? So it's starting to be interesting, and there's starting to be a little pullback where our customers rather be in their availability zones, if possible at all. There's a big change between what they do in the US and the rest of the world. So I guess the real thing is you have to really know your customers and know where they're going to go. Mm-hmm. Otherwise, you can get, even though everything looks euphoric with great tailwinds, you can get stuck with property. Even property with power. Even though power now is the big limitation, power is the one reason that's keeping us from building a bubble in this thing. So thank God there's no power. But when there is going to be power, and humans are very creative, they make power. When there will be power, we've got to be careful about where we are to try to not get stuck.
Okay. Can I add to that? Avner made really good points. Effectively, the preponderance of power has, in various locales, has created a situation whereby tier 3, tier 2 locations have become tier 1 locations. And we've seen that. It's been evidenced in our businesses, Avner's, mine, our peers and contemporaries' businesses, across the spectrum from jurisdiction to jurisdiction. And previously, we were maniacally focused on AZs and availability zones. We would map it out. We would make sure we're 20 kilometers from fiber from the closest parent data center within an AZ. And we still do that to a large degree, and we try to make sure we have a cloud migration underwrite, so as a backup situation or another vertical from a revenue stream perspective if AI doesn't come to fruition in that particular locale. But again, power being the absolute scarcest resource has changed the industry over the last 36 months, almost to a degree that it's unrecognizable from the parameters that we used to work under previously. And that's why if you can find power in a location that works, and there's surety of supply, and there is a large quantum of power that a hyperscaler can scale into over time, you certainly have a product that's sellable. Even if it wasn't a tier 1 location in the past, even if it was a tertiary location as far as people are concerned previously, That's currently the way things are moving in the marketplace. Now, to Avner's point, there has been a little bit of retention. We've seen DeepSeek, we've seen retrenchments from some of the hyperscalers, but I think that's just a rebalancing of portfolios. And I expect that over the next sort of 2 to 3 quarters, you're going to see a very steep incline again in terms of demand profile.
If I may add to that last point that you've made, Chester, and also I'll add into what Avner's said earlier. So, we had the moment of this DeepSeek, and, the question in everybody's mind is, does it mean fewer data centers, right? And, the impact at the beginning was, hundreds of billions being erased from the stock valuations in the market. But then what we've seen since the DeepSeek, we've seen actually all of the big players moving in and investing in actual physical infrastructure. And I don't mean just R&D, and you have 100 billion Microsoft, Amazon 70 to 80 billion, you've got Google is there, and all the big boys are following. And the reason why they do this is not, it's not just, it's not a phase. AI is not a phase. AI is a land grab for compute demand. So this is what it is, and I believe it's important to highlight that this is not a theme that is it's here to stay.
I think I think you're right. And what we've seen is the capex profiles. Basically, all the big 4 hyperscalers could have changed their capex. DeepSeek came out in January the 12th approximately, right? Or the 19th, I think. When it came out, the revelations took about 2-3 weeks for everyone to kind of work out that this was a kind of a new age in reasoning. DeepSeek OR1 came out, changed things slightly, made people rethink. The earnings reports, and the forecast for the year were kind of, a month later in terms of the big hyperscalers. None of them revised downwards their capex forecasts. We've gone from 220 billion of capex for the big 4 hyperscalers to 330 billion of capex. AWS themselves are doubling their capex forecast for 2025 from 52 million to 100 million. Everybody else has gone up by about 20 to 30%, including Microsoft. So I think that, and even if we looked at what happened with respect to GTC last week and Jensen Huang and his speech and what he revealed, we can see that the compute densities, it's the configuration of data centers that might change. And the new GB300s and the new Rubins and Rubin Ultra and the Feynman that will come out over the next 3 or 4 years they're going to change the way data centers are configured. But again, power being the natural constraint, and it is a natural constraint, it is going to be that kind of limiting factor on what can be built, when, where, and how.
Miles, just to interject one point from the usage point of view, because I think the DeepSeek point was that at the end of the day, you're able to do stuff with less computational power, right? And one of the things that we see with our clients is that those who go, want to get results out of inference, they don't necessarily need the massive GPU estates to be able to run them, right? They can solve, I would say, more than 80% of the problems with more traditional architectures. So there's something to be said about that. This doesn't mean that, the evolution is not going to be as you explained. But we're seeing also from the corporates, from the enterprises, that they first want to exhaust all possibility of solving their AI problems with inference, with lower computational requirements before moving into the bazooka that is going to be using as many GPUs as possible.
The DeepSeek thing reminds me of high school, because I used to copy a lot of my tests. So I did really well because I copied from really good guys, but the people that copied for me did not do well at all.
Well, DeepSeek not only,
Well, hold on, that's a really, really brilliant analogy. It really is, because it's about the distillation, right? It's about the parent-teacher relationship. In other words, you may have Einstein teaching you, the theory of relativity, but, and you may learn it, be able to deploy it and apply it really well as a student, but you'll never be as good as Einstein. And that's effectively what's happened with DeepSeek. It's very good at implementing. Mm-hmm. It's not probably as good as people make it out to be.
It's how to get results with less processing power.
But guys, even if it does, decrease, let's say, the cost of training workloads, what happens is going to increase, obviously, the adoption. It's going to increase the users, the use cases, and all of this is going to lead eventually to more the need for physical infrastructure.
I agree, and like just for example, if you just take the Hopper GPU that was produced in 2022 and is still obviously, it's becoming legacy at this point, right? And you compare that to the Blackwell Ultras, well, in terms of the reasoning capacity of the Blackwell Ultras is effectively giving a response time of 10x to the Hopper. Hopper would take a minute and a half to go through some very extensive reasoning logic on a difficult question, right? Now the timeline is sort of 10 seconds with a Blackwell Ultra, and that's gonna be infinitely smaller by the next iteration of chips that come out. And what's gonna happen is that when this becomes public and it's for monetization and we're using it daily, none of us are gonna be waiting around for 10 seconds for an answer. We'll want it absolutely instantaneously, or we'll move to the next product. And that's the next phase of AI, is when we all start using it. Everyone in this room for everything that we do.
That's inference, right?
Well, that's inferencing, but it leads into, I'm sure Miles is going to ask a question on it later about agentic AI and how that works.
Yeah, we are going to talk about that. So thanks. So let's move on and talk about risks and opportunities and how we navigate that, because it's more than just power costs. We also got to consider, right, that our president Trump, he's expressed enthusiasm for AI, but also
President here too?
no, he's not. but his picture is everywhere. But he's implemented tariffs that could increase the cost for data centers. So I want to with increased tariffs, right? It's going to have an impact on steel costs, aluminum costs, semiconductor costs, and network equipment. So this presents a significant challenge to growth. So we want to talk about how investors are navigating through this complex landscape, particularly rising costs. Okay, so Chester, we talked about the massive capital outlays and long-term commitments that you've been involved in, right? But how are you seeing risk-return profiles for these investments evolving as AI workloads become more dominant? What are the key factors that investors are looking at?
Yeah, I suppose we always solve for a development yield anyway in terms of our build-out. So we have an internal parameters on a per jurisdiction basis that we think is appropriate. And as long as as long as we understand the cost of building our data center, what the internal infrastructure is put into the data halls themselves by the customer is really their own. It's really their own deal, right? Mm-hmm. And we will help them with that if they require us to do so, but it's not part of our standard form build. And we do help them at times, right? I think, look, from a liquid-cooled perspective, liquid-cooled data centers are more expensive to build in general. You're probably talking about 20 or 30% more expensive. Just to give you a rule of thumb, for a 100 megawatt IT load data center, for us as a developer, land, power, building the shell, putting all the infrastructure in the OFCI, it's going to cost sort of $1 billion, right? And then, I think if that's going to be a liquid-cooled data center, it's probably 20% more than that. So I think those costs are going to be reflected in, what we expect from a leasing perspective from our customers. So they're going to absorb those, and that's going to be an industry standard kind of worldwide in that regard. I just want to touch upon a point that you talked about in terms of tariffs, which I think is very interesting. So a lot of the infrastructure, a lot of the deployment infrastructure that a lot of the hyperscalers use, certainly from a US perspective, is manufactured, racks and other things in Mexico, right? And, there are going to be tariff implications associated with that. Trump has been very expressive and, in terms of what he's doing with respect to some of his neighbors and applying tariffs. And, that's his own policy decision. And if he thinks it's the right thing to do, he should do it. If he thinks it's not the right thing to do, he shouldn't do it, but that's his choice. But the one thing that we have to do as an industry, and I think the only European on the data center coalition, which is a US-based data center sort of association, that kind
advocacy group.
Advocacy group is probably the best word to use. Yeah, absolutely. That supports the data center industry in the US. We have already made submissions, at federal level to people in the federal government. Politicians, senators, and congressmen and women, effectively saying, look, here's a letter. These are the things that are going to be affected by the tariffs. Can you make exception for data centers in this regard? And we see how things, there are all other avenues being used as well. There's a lot of our customers that are talking to people too. We just think it could be detrimental, obviously, for customers, not particularly for us, right? As developers and operators, we build data centers. We make sure that we source now, certainly more than ever, our OCI equipment and everything in country where and when we can, especially as it pertains to North America and the US. and US particularly. So we're very cognizant of that. We're solving for it. So we don't actually see any massive implications for ourselves because we're able to solve for that supply chain.
Sure.
But we do see for our customers, and we try and help them out when we can, and we respect to that. But hopefully there's some policy decision changes that might happen.
Yeah, I moderated a panel in New York just a couple of days ago at DCD, and one of the panelists says, "Don't worry about what Trump says. Just watch what he does."
I think what he says, though, I mean, uncertainty is never good in business.
Yeah. Correct.
And we sit here in a place where we really don't know. There's a lot of steel in these buildings. There's constraint in supply chains. So you get creative. To get a generator in the U.S., you're talking about 2 years right now. And our customers want stuff yesterday, or at least in 26. So there's and they're willing to pay for it. So now we went to a place, I'm going to age myself now. It used to be a place where data centers was a very competitive market. A customer would go into Virginia, and there would be a lot of them, standing there begging the customer, please choose me, please choose me, please. I'll give you data center space in the 60s. I'll give you this, I'll give you that. Now, basically, who's calling? Nah, the credit are not good enough. Let's get the next guy. Just who's that? That's not a person. So we got choosy, and we are getting a little bit greedy. Prices went up, I think, 100% since we've seen in Virginia, at least.
Well, yeah, let's talk about that real quick. I mean, it's more than just power costs, but you touched on yield on cost, right? And we don't talk about rent so much, but rents have significantly increased, maybe as much as 30% year over year. So, given your perspective on the sustainability of these cost-driven rent increases, which is, primarily driven by, rising construction costs, interest rate volatility, inflation, and supply chain disruptions, what's your perspective on whether these cost-driven increases represent a permanent shift in rent increases?
In my mind, it's a unique point in time that I don't know how long it'll last. It's the squeeze in power. It's hard to find power right now. If you have immediate power, if you can build something quickly, you can get a very high rent for it. Just because you're the guy who can supply it, especially if you're a supplier that has a good track record that people believe and understand. You can command high rates. Do I think it's going to last forever? No. Our customers are very smart. They know the market. They're very few. They will work rates down if they can. And they're trying to develop themselves, which is the other thing. We're competing against self-perform, which right now they have issues with. But again, they're very smart organizations, and they will come back and do whatever they can to reduce rents.
Okay. Well, that's a good segue to markets. Let's shift to new and emerging markets. The flap D markets are the primary markets, but let's broaden our view. Which other regions are emerging as promising data center hubs? So I'm going to direct my next question to Maz. Goldacre has a global perspective on digital infrastructure. What factors are currently driving investor interest in Tier 2 and Tier 3 markets? And how can these markets effectively compete for capital against established hubs? Achilles, you could join in too.
Yeah, absolutely. I think one of the major factors driving interest in markets outside of established Tier 1 locations is power constraint. I think that's probably one of the major drivers, and we are seeing, to the extent that it's possible, end users are looking to expand within the availability zones in Tier 1 markets or deploy within close proximity of those availability zones. But there is just such a shortage of power in those locations that they are forced to move to other markets as well. And I think that will continue for a while going forward.
I think, for example, if you think about Frankfurt, London, Amsterdam, you're not going to get any significant power in those locations till post-2030. So what's happening is that everyone's trying to deploy. People still have requirements to deploy, so you have to go to Tier 2, Tier 3 markets in the same countries, and we're looking at that. And customers, to Avner's point earlier on, there's there's a sea change in the way customers view things. If you can find the power, they will find a way of making it work. Because we're all trying to solve for the exact same problem ultimately.
Yeah. No, I completely agree. And there's another thing that you need to put into the equation, and that's it's not just a return let's say, the yield on cost that you're getting to develop in these markets was becoming increasingly more difficult to do business in the flat D, but it's also the return on effort. So it's a different metric that we like to use in-house. So it takes so much longer. It's not just the power, it's also the permitting, which takes longer, and everything gets stressed. And this is at the backdrop of the exploding, let's just say, European data center demand. If you look at research suggests that we're looking at 5x or 6x over the next decade of demand. So with the core markets being at capacity, where's this demand going to go? And this is where really the opportunity opens up for the tier 2 and 3 markets. And you've got actually markets which they have power availability. In some of these markets, you have actually cheaper power. You have cleaner power, solar in the south, hydro in the Nordics.
Tell them Greece, yeah?
And the return on effort is a lot easier. I mean, it takes so much shorter time frames, from land acquisition to to be able to start beginning the construction. It takes half the time that you would do in a core market. So I think this is why investors, have noticed, and as Avner said earlier, it's power is the key, and this is what matters. And these markets are actually going to be meeting, the demand.
I'll present another key, and sorry to keep going to it. The key is what the customers will do, and I think there's a big difference between U.S. and Europe. In the U.S., first of all, U.S. has a lot of AI. Europe does not. There are virtually no AI deployments in Europe. Customers can't do AI. The regulatory framework is not ready for it. There's a couple of CoreWeave deals running around. There's a couple of TikTok deals running around. If you can finance them in big scale, you're a better man than me.
Certainly TikTok.
Yeah.
Let's stop right there. Right, you've got a lot of experience in AI, and people in the audience here from Europe, they don't have as much experience as you, but the landscape is evolving very rapidly, right? So you have distinct workloads like AI training, inference, generative AI, and an emerging area of agentic AI. It's each placing unique demands on data center infrastructure. So how is Serverfarm differentiating its investment strategy to cater to these varying requirements? Like, how are you assessing the differences in power density, cooling solution, compute capacity? How are you prioritizing your investments in these facilities?
So, again, we've been in here long enough to have data centers that used to be 3 kW rack, and now they're at 60, same building. So we've converted buildings from 3 kW rack to 60, and now going to more. We're sitting with our clients right now, space that's already leased a year ago, and they're going, hey, stop, we're changing our deployments. We're getting CDUs, it's going to be water-based, it's going to change, let's redo it. So we see the change at real time these days. Mm-hmm. We see a lot of availability zones, data centers going to AI implementation, and a lot of them for inference. So I think the way, I'm spending kind of every day trying to understand this, but the way I see it is a lot of the learning jobs are happening around the U.S. They're U.S. bases. That's why in the U.S. where there is power and ramp to a lot of power, you will probably lease it. There was just a big deal done in North Dakota. Check it out. Which nobody would ever thought would happen. But the inference is still preferably going to go within the availability zones. Mm-hmm. Because of lack of power, the customers are opening new availability zones. In Europe, I know of one credit guy that's building outside of availability zones. Otherwise, nobody else really cares.
So just talking about that, is that, it's funny because I've been in, not 20 years, but 11 years in the data center industry. I've been here a while. And we started off, yeah, exactly, barely. I'm holding on to it just about. But basically, I remember when we did, a data center, we did a lease for 1 megawatt, 2 megawatts. We did one for 7 megawatts in 2016. We thought we had, oh my goodness, we got out the champagne. We thought it was incredible.
Many more parties.
Yeah, exactly. It was way more parties because it was easier to do it then, right? But the point is that then we've gone to these massive deployments. If you got half a gig, that's fantastic because the hyperscalers, half a gig, right? Because hyperscalers want to deploy into it. And like a lot of our line of sight, a lot of the land that we're buying, everything's in the US to a large degree because that's where the pipeline is. It's also the easy button for the customers. Also, we know it's got 2 verticals that can apply. It's got cloud migration if you get it within an AZ, so it has its cloud migration underwrite, or it can be an AI data center. So that's how we're looking at it. And that's to the points that were made earlier on. A lot of the AI deployment is in the US and in regions of APAC. Not a lot in Europe, right? But we're nearly going to come full circle in the next 2 or 3 years when, Avner and myself and, others will be effectively looking at 20, 30 megawatts or 10 megawatts within an existing AZ in a tier 1 metro, because that's where the inferencing has to happen. So that's the monetization. That's the eyeball monetization has to happen in those jurisdictions. And that would probably be very high margin rents, right? Because there would still be a scarcity of power. But it's certainly the way things are going. It's nearly coming back to where we were sort of 10 years ago.
Well, let's hear from Kyriacos. Who are the primary users of AI infrastructure today, and how is that evolving with AI capabilities reshaping user needs?
Well, I mean, obviously the hyperscalers are massively using that infrastructure, but I think from where we come from, we have much better visibility on what corporates are doing, so the big enterprises. And I have to say that we've seen them been a bit behind in adoption compared even to startups, right? We see the startup community immediately jumping on the bandwagon and using AI infrastructure as much as possible. And one of the reasons that is holding them back is cost. Because at the end of the day, they don't look at the granular level, but they look at the business case for what they want to do. They started having some second thoughts once they completed a full cloudification of their infrastructure, and then they realized, what costs are with respect to their initial business cases. And they're concerned now that, they start doing prototyping and proofs of concept in AI, and they're concerned that once that would scale up, the cost would be out of control. So there's a big concern right now, I think, from large enterprises, and we start seeing a trend whereby both for cloud and for AI, they're thinking about what should they be investing themselves. So that might be another opportunity for you gentlemen around this, directly working with some of the large enterprises.
It's too expensive.
Yeah, but
so that's where people like CoreWeave come in, right? Northern Data, that's those guys, right? So if you ask IBM, I asked the CEO of IBM the other day, I said, hey, how come I don't see you? Where are you? I see all your friends. Where are you? By the way, CoreWeave.
Right. Oh, is that where they are? Right.
Right. No, but I'm speaking about large industry, not necessarily the likes of IBM, like large industry that might want to create its own thing. I think the other point to highlight that is probably because of the European regulatory environment that you alluded to before, maybe other parts of the world, I don't know, maybe you have better visibility, but we're seeing a trend of what is called sovereign cloud, sovereign AI, taking some importance. I don't know to what extent, the geopolitics is now fueling this discussion, but certainly there's a lot of discussions in different countries about how to have data residency and whatever that means in terms of infrastructure that needs to be developed.
That's a brilliant point. That's something that was discussed at Davos, from a lot of people, a lot of geopolitical views on this. But effectively, is that for somewhere where they have very low power costs, like the UAE, you can have a sovereign data center that's owned by German owners or French owners, has the exact same rights as an embassy abroad, like literally the exact same data rights, but at a sort of a fraction, I suppose, of the running costs of the very high energy costs that we have in Europe. And that's something that, they've spoken about at Davos, we've spoken about afterwards, there's a lot of geopolitics involved, but I reckon over the next 12 to 18 to 24 months, you're going to see Europeans solve for this. Because we don't have our own AI data centers here.
And this is when the European data directive, which is coming to effect in September, is also going to put additional pressure and is going to lead effectively to, let's just say, more distribution across Europe for data centers. And I think this is going to be massive. Because what I read is like there's around 3 to 6 gigawatt of European data which is actually stored and processed outside of the Eurozone. So eventually there's going to be, starting from September 25, and obviously there's going to be some lag, but there's going to be a lot of repatriation of this European data. Where it's going to go? Exactly, where power is, I suppose.
We, I guess in the US, have a president that keeps saying that everybody's taking advantage of us. The world's taking advantage of us. We're poor us. You know, woe, us Americans, everybody's in a way. And we're dealing with US customers buying data centers all over the world that are owned with a lot of US companies using American chips, running the next wave in the world. I think the US is doing pretty well. And when you're doing well, I think you should be generous and help other countries and do the best you can to share it around. And I think humans have to get along before machines show us the way.
Maybe machines are going to make us feel better about each other.
No, they're going to think we're easy targets.
On that, I mean, you know, we talk about AI and how it's rapidly automating tasks and even decision-making processes that were once the domain of human people, right? Kyriacos, could AI and its continued advancement disrupt Accenture's core business to the brink of extinction? And how is Accenture specifically prepared for this paradigm shift?
That was uncalled for.
That's a tough one. That's a tough one. No, I'm happy to answer that question, and you cannot use it to invest or not to invest in Accenture. But it's disrupting, I think, all the knowledge-based businesses. So we as Accenture, we've been preparing now for quite some time. We're making, already we're in the middle of a $3 billion investment in AI. I think we're the largest investors in, AI use cases and AI technology nowadays in the world. So we're deploying all that. We're trying to reshape our pyramids of people, how we deliver projects. So basically the whole way of, doing work. But I think, everybody needs to be not concerned, but see the opportunity. I always like to see the opportunity. There's definitely an opportunity. There's a big disruption, so that's an opportunity for enterprises to reinvent themselves as well. And I think, I think Chester mentioned it before, everybody's going to be user of AI, right? And now with this agentic architecture, which in Accenture we call the cognitive brain, because you're going to have like a cognitive brain coordinating all the agents that are working for you, plus yourself, plus your team, plus your teammates, and your company, and so on and so forth. It's a new era. It's a completely new era. And we all need to be aware it's going to be disrupting. And you know what? When Gen AI first appeared, we're saying, oh, it's the revenge of the blue-collar workers because it's affecting the white-collar workers, right? But now, also with robotics, it's going to start impacting the blue-collars as well. So everybody's going to be disrupted. So we better be, have our eyes open and try to take and grasp the opportunities that are out there.
We've got 1 minute left, have we, Miles?
1 minute left. I want to ask the audience if they have any questions for panelists.
I'll answer one that wasn't asked then.
All right.
I just think it's really interesting about what's going to happen in the future. I think this is a pivotal moment in humanity, truthfully, in terms of how AI is going to affect our everyday lives, our business lives, how we work, what we do with our time, our work lives, our family lives. I think it's going to have a massive impact on us. I think people are really conceptualizing that because it's very hard to conceptualize something that hasn't happened yet, right? So we can think about it, but unless it happened, it's very far away. And there is a school of thought, right, that believes that, what is going to happen? So over the next 2 or 3 years, you're going to have a lot of deployment of agentic AI within businesses and at home, right? They're going to be learning processes within our organizations, and they're going to be taught, and we're going to be retraining people to use the AI. Right? That's going to be the next 2 to 3, 4 years. After that, AI is going to become so good that there'll probably be an element of displacement that happens in the workforce, right? Maybe some people will not be required for those jobs because AI has gotten so good at it. And that will cause some unrest. You know, there will be, people will question AI at that point. And I think what will happen thereafter is that we'll find some sort of equilibrium whereby we work less, AI does more. We don't have a 60-hour week or a 40-hour week or a 30-hour week, depending on where you live. You have a 10-hour week, right? And the rest of your time is sort of spent doing other things, right? And then we come on to the question of UBI, Universal Basic Income. I've spoken about it for the last 10 years, but I think in the context of AI, it's the only time that it actually has a real significant effect. You're going to have massive winners in AI from a corporate perspective. They're going to be taxed potentially by the government to help supplement costs of people who are displaced from work, right? And this is the kind of, it's going to be this is kind of equilibrium. We have to march that path extremely carefully, right? But I think we can all get there. And I think, you know, I would like to view AI and its deployment as utopian and not dystopian, but it could go either way.
I would agree 100% with the utopian view.
The history of the world tells us all this is not true. Because 25 years ago, we thought, oh man, this internet thing is going to come and we're going to buy all our groceries online. We're never going to go to the shop. You know, basically everything we're going to do is going to be online, and people will work less. And people are working more. They're now never off. They're getting emails all times a day. People are very busy being lazy. We do everything possible to make our lives lazy, to take to this point where we work 3 days a week. And every time that happens, we get busier. You know, I see AI like Caterpillar. We used to have 100 people digging land development, thousands of them, you know, building the pyramids. Now we have 4 guys with tractors. We build more.
Yeah.
It's not that everybody's out of work. They're doing different things. We find ways to get employed, and we're going to keep very busy trying to find a way to be lazy and never get there.
I think that's a good way to finish.
I agree with you.
All right, well, thank you. If you have any questions for our panelists, you can meet us in the hallway. Thank you again.
Thank you.